This is the Domain Magnet Show, where you'll learn everything you need to know about buying, optimizing, and selling online businesses with your host, Michael Bereslavsky.
Welcome, podcast listeners and viewers. Today on this episode, we have John Warrillow, author of Build to Sell and the founder of the Value Builder System. Hi, John.
Hey, Michael, how are you?
Good. So it's good to have you here. I've read Build to Sell quite a few years ago, but I remember it made quite an impression on me in understanding higher level on how to really grow a business, how to improve it. So I'm curious, how many people do you reckon have read Build to Sell so far?
I have no idea. It's been translated into like 13 languages, and it's been a great run. And I have no idea how many people have read it. I can tell you that of the three books, we've written a kind of a trilogy. Built to Sell was the first, Automatic Customer About Recurring Revenue the second, and now the new book, The Art of Selling Your Business, was the third. I can tell you that Built to Sell is the most well read. It's the one that I get approached about from the most part, and it's really about how do you create a business that's not dependent on you, which of course is a transferable business, as you know. So that's the book, Built to Sell.
And do you know how many people bought it? Would it be like 100,000, a million, more?
Yeah, no, we'd be into the hundreds, of thousands.
Sounds good. Yeah, so you summarized it briefly, but can you give us a little bit more of an intro for those who haven't read the book and don't know much about it? If you can explain it like a few minutes.
Yeah, the core idea is that for a business to really have transferable value, it needs to be able to run without the owner. Right. So if the owner is, and so many small businesses are too dependent on the owner, right? They're not transferable because the owner needs to come with it. And so the kind of core idea in Built to Sell is how do you structure things so that everything is not dependent on you. And that gives you the ultimate poker hand. Like if you can create a business that's not dependent on you, you could sell it, but you don't have to. You could also scale it. You could bring in a management team. You could sell half of it to a private equity group. Like you could do lots of things. You've got lots of options. But if it's a business that's dependent on the owner, you're really stuck. You kind of have a job, and that's not great. So for most entrepreneurs I interact with, they're not trying to become the next Elon Musk. They're trying to build something that gives them freedom, that allows them to decide where they want to work, how much they can earn. They don't want to be held down. And so the kind of idea is create a business that doesn't require you, and you've got sort of all the options.
And who would be the target business here? What's the minimum size or like in terms of employees or things like that?
We have a lot of startups that read it, but really when I was writing it, it was really for an entrepreneur, generating revenue of somewhere between 500,000 top line and 5 million top line. Like that was the space that I was thinking about. The story is an entrepreneur. The book is based on a story. Alex Stapleton is the protagonist in the story, the hero of the story, so to speak. And his revenue is something like $1.5 million. He's got like a half dozen employees, and he's running around with his head cut off like a chicken. It's the classic story where you grow the business. When you're really small business, like when you're self-employed, I think it's like running a business is not that hard. You're really just selling your time, and you're effectively, you've got a job. It's just a self-employed job. Whereas when you grow to say 5 employees or 10 employees, all of a sudden things get real. You've got mouths to feed. You've got, you've got revenue you've got to generate, and all of a sudden things get really, really serious really quickly. And that's the stage that I think Built to Sell helps for, is where you're trying to like get out of the fog of war. You're trying to build something that's not so dependent on you.
And that's interesting. I've seen, having been in business for about 15 years now, I've seen on my own experience and other people that there is some kind of threshold that seems to exist in that range that you mentioned, like 500,000 or 5 million, that very few people are able to cross it. Very few businesses seem to make it. are further from.
I think in the US, it's 4%. 4% ever crest $1 million in annual revenue.
And why do you think
that's,
that
again,
is?
Well, it's because the owner, it's the owner, the revenue is tied to the owner, right? And so when the owner runs out of hours in the day, they can't sell anymore, and therefore the business plateaus. So in a professional services business, it might hit very early. I know most of your listeners are not professional services business, but it might be as low as say $200,000 or $300,000 in revenue where you reach that plateau. And in a SaaS business or e-commerce business, it may be higher, but that's where we see this sort of fork in the road, frankly, where a lot of business owners step off and they say, okay, I've reached whatever, $500,000 in revenue. It's a great business. It's a lifestyle for me. It gives me tremendous independence. I can pull out lots of money. I can run out all my expenses through it. I'm good. I'm going to just run it like a lifestyle business. And so we see examples of that. Tim Ferriss, for example, had Brain Quicken. It was a supplements business. And when I asked him about why he sold it, he said it was a great business. I was only down to like 4 or 5 hours a week running it, which is obviously the book he wrote, 4 Hour Workweek. But he said it was still like my brain was running antivirus software, always sort of churning through the business, and I could never really feel like I'd leave it at night. It was always there with me. And so that's why he chose to sell his business. For some entrepreneurs, they don't feel the same burden, right? They reach that point of $500,000 in revenue and they decide, well, I'm just going to leave it as a lifestyle business. But for others, and I would put myself in the latter camp, it's hard to switch it off. And so that's why I think a lot of smaller businesses decide to sell or decide to do, make some transformational changes in their business because they don't want to run a lifestyle business. And that's where Built to Sell can help and others.
Yeah, that's certainly something we see as well with businesses we acquire or broker for clients, that sometimes we just don't spend much time on it. And we as buyers or our clients often ask, why would you sell it if it only takes you a couple hours per week to run and it's quite stable? Why would you sell it? And this is something that many people don't understand, is that it might only take you a couple hours, but you are kind of constantly thinking about it. So it's always occupying some space in your mind. So it's difficult to fully disengage.
Yeah, we also talk about this thing called the freedom point, which is the point at which selling your business will generate enough liquid cash to live comfortably for the rest of your life. And when you reach that point, I think, Michael, it makes sense to pull up and say, well, why would I keep going? Like Warren Buffett's got a famous saying, I'll see if I can paraphrase it. He says, why would you risk something you care about for something you don't care about? And what he was trying to say is, like, once you've got the aspiration, the nest egg that you've created, why risk it for that next little bit of alpha on whatever investment you're trying to create? And so for a lot of entrepreneurs, I think it's worth calculating the freedom point. Again, it's when the sale of your company, after you pay your broker and after you pay tax, what's left over is enough money for you to fund the lifestyle you aspire to have for the rest of your life. It's worth asking yourself, why not sell? Because selling will create that wealth, make it liquid. Not selling means you're the gambler at the poker table, right? Who has just won 5 consecutive hands, and the dealer is saying, put all your chips on the table again, right? Because you're risking everything. You never know when the next black swan event. I just did an interview with a guy named Gizdecki. I think his first name is Adam. He built a great company where they created template-based apps for the iTunes store. So if you are a restaurant, right, or a gym, and you wanted to create a mobile app for your restaurant, it might cost you $50,000 or $60,000 to go out and hire a developer, create like a really slick iPhone app. Well, Gizdecki said, like, most restaurants don't have $50,000 to spend on an iPhone app. So he built an iPhone app tool, like a wizard that would enable you to create your own iPhone app. Well, this business took off very, very quickly. And I think, if I'm going to go back, I interviewed him for Built to Sell Radio recently. I think he was generating call it $8 or $9 million of revenue, when all of a sudden, Tim Cook decided that overnight, they were no longer going to accept template-based apps in the iTunes store. And overnight, Gizdecki's phone started to ring off the hook from customers who were building these apps and were no longer able to use them in the iTunes store, which is the number one dominant, most, obviously, player. And Gizdecki's business went from $9 million, very profitable, growing like a weed, to literally nothing overnight with one decision from Apple. And that's really what can happen for a lot of businesses. A lot of businesses went into 2020 on the back of their best year ever. And then out of nowhere, we have a global pandemic and the business in some sectors, in particular service businesses, gets crushed. So we don't know what's going to happen. And once you crest the freedom point where the sale of your business would create enough liquid wealth, it's worth asking yourself, well, why not sell? Why not make that wealth liquid and then go do the next thing that you're excited about? Because Gizdecki, by the way, I should finish that story. He cold emailed Tim Cook and said, this is crazy. Our apps are helping people. He actually, right after one of his apps, a template-based app, was featured on the Megyn Kelly show when Megyn was describing how one of these apps helped a teenager avoid suicide. It was a suicide prevention app. Megyn Kelly interviewed this woman, and then Gizdecki sent that video of Megyn Kelly interviewing the woman to Tim Cook and saying, is this really what you want to pull out of your iTunes store? Long story short, Gizdecki got his apps back in the iTunes store. The business went on to be a tremendous success. He sold it for more than $20 million. But there was a moment in time where Gizdecki was almost out of business. And that's just worth remembering, I think, when we reach the freedom point.
Yeah, that's a good story. It's certainly interesting to see how the platform risk can be a major risk. And we see that a lot with Amazon businesses, for example, that focus completely on Amazon. And then at some point, Amazon just decides to change something and basically closes an account. And we've seen something similar with Facebook and Google as well for businesses that rely on the API or the specific features. So that could be a major risk.
Yeah. Value builder, we call it the Switzerland structure, where you want to make sure none of your business is not dependent on any customer, employee, or supplier. And Michael, what you're referring to is a supplier risk, platform risk, where you have, as Gizdecki had, risk that iTunes would change its business model. Another example, I just did an interview for Built to Sell Radio with a guy named Ben Leonard. Ben built a wonderful business. He built Beast Gear. Interesting story. Ben, at a very young age, had a heart problem, which he was a very fit guy, always working out. And he went one day and had an issue with his heart at like the age of 25, very young. And so the doctors basically put him on bed rest and he couldn't work out. And so he's like unpacking his gym bag, basically putting it all away. And he looks at this gear, like these skipping ropes and these straps, and they're all kind of frayed and torn apart. And he's like, God, I got to build like better gear. This was premium stuff, expensive stuff, and it was all falling apart. And so he decided that in his time off, he would create better workout gear, better straps and accessories for people who work out. Long story short, he creates this company called Beast Gear, and he creates an Amazon store. He buys like 250 ropes from China, gets them branded with Beast Gear, and then sells them on a little basically crude Amazon store. Anyways, long story longer, over time, he builds this up to, I think it was 4 million pounds in annual turnover. Tremendous success, did a lot to build the business off Amazon, created a whole Instagram following, got people to opt in to mitigate for his platform risk. So he created a customer list off Amazon, et cetera. But when he went to sell the business, to your point, Michael, the PE group that bought it said, we love what you've done to build the kind of off Amazon stuff. And at the same time, we do realize that you do have some platform risk, because at the time, I think 95% of his revenue, not his customer relationships, but his revenue is still coming off of Amazon. And so I think he traded at 3 times top line revenue, in and around 3 times top line revenue. Excuse me, not top line revenue, 3 times EBITDA, 3 times bottom line, profit before interest, tax, depreciation, et cetera, which is a relatively low multiple for a business of that size. But it was because of the platform risk that he got a little bit of a haircut there. But again, he would never have sold his business had he not created an off Amazon presence. So he did a great job of doing that. But any business with 95% of its revenue from Amazon is going to take a bit of a haircut.
Yeah, absolutely. So going back to the idea of build to sell, the idea of removing yourself from operations so that the business is not dependent on the owner. First of all, can businesses pass that chasm, that threshold we mentioned without doing that? Do you see businesses that still stay the same structure but manage to grow beyond that, beyond 5 million, 10 million, maybe like have 20 people, 30 people more? Or do you think that's just not possible to move forward without doing all the necessary steps?
Yeah, no, for sure. I think you can grow, and I've seen examples of growing businesses that are much larger than $5 million that have lots of different things they do. Usually, one of 2 or 3 things has happened. Number one is they've sold a bunch of equity, right? So they've raised a bunch of rounds of outside capital, friends and family, investors, et cetera, and so they've got lots of money to kind of wipe out or wipe over any inefficiencies in their model. And so they can grow beyond just the owner very quickly without having to narrow down what they do. I just did an interview with a guy named Jason Fleck who built an app for TV companies to use. And yeah, he quickly scaled to something like 50 million in revenue, but he only owned at the end a very, very small slice. So I think you have to give up a lot of equity to raise a bunch of money to grow like that. The other, in a professional services context, is you take on partners, right? You reach a point of 300,000, 500,000, $1 million of turnover revenue when you can't grow anymore. And the only way to attract the kind of talent that can sell customers, because that's the one currency in a professional services concept that is hard to replicate, is you have to give up equity. So you see law firms, accounting firms, they talk about revenue per partner, because once the firm reaches, again, $300,000-$500,000 in revenue, you got to get partners. So yes, we do see examples of that, but very rarely does the owner maintain 100% equity. And it goes back to the age-old question: would you rather own 100% of a relatively small business, or would you rather own a tiny slice of a company you don't control? I interviewed a guy named Rob Walling on Built to Sell Radio who built Drip. Have you ever had Drip? Have you ever had Rob on the show, Michael?
No, but I think I've interacted with him before, yeah.
Yeah, he runs a podcast called Startups for the Rest of Us. Anyways, I interviewed Rob and talked to him about the sale of Drip. Drip was an automatic email marketing software with some bells and whistles. And he built it up, but did it very independently, didn't raise money, didn't take a VC round, even though he was in a very, very acquisitive space, e-commerce or email marketing. In any event, he built it up to $2 million of annual recurring revenue. So still a very small business. It was like him and a few employees kind of thing. But he wanted to remain independent, didn't want to go down the classic software route of giving up all his rounds and rounds and rounds and rounds and rounds of equity. Anyways, long story short, Walling started to receive offers for Drip, and he was in the headspace of 9 to 13 times top line revenue. Those are the kinds of offers and the kind of conversations he was having. And he had 100% of the company. And in many cases, I see examples of people who do exactly the opposite. They give up lots of equity. One guy I interviewed on Built to Sell Radio is a guy named Rand Fishkin. Built a great little company called Moz. Do you know Moz, Michael?
Sure.
Yeah. So Moz SEO software, built it up to $5 million in revenue. So still a relatively small company when he gets approached by a guy named Brian Halligan, co-founder of HubSpot. HubSpot is a massive company on the way to becoming a unicorn. Moz is a $5 billion business. Halligan offers Rand Fishkin, the founder of Moz, $25 million of cash in HubSpot stock for his $5 million business. And Rand says, well, no. he thinks he's going to 10 million, and he thinks his business should be worth 4 times top line revenue on the future. So the future looking, and go counter offers at 40. Halligan says, no, there's no way we're paying $40 million for a $5 million company. And they part ways. Well, Rand raises VC money. VC money gets him a bunch of cash quickly. He goes and invests in a whole different other set of products, some of which are successful, others are not. The company starts to bleed cash because of how diversified it has become, how many products and services it's offering. And eventually the VCs actually removed Rand from the CEO spot. And they continue to run the business without him. I interviewed Rand and I said, what was that like? And he said, it was terrible, like watching your baby that you created, be run by someone else. And I said, but clearly your shares in Moz must be worth a truckload now. And he says, actually, probably not. I don't think they're worth anything. And I was like, what do you mean anything? He's like, well, the way VCs invest, they usually have preferred shares where over time they get a preferred return. And so if they hold for long enough, as a founder, it washes out. It has washed out, in his view, most, if not all, of his equity, because again, they're guaranteed a preferred return for each year they hold the investment. And I said to Rand, what would that offer from HubSpot be worth these days? And he said, well, based on the appreciation of HubSpot stock, it would probably be worth close to $200 million versus right now, what his stock is worth is perhaps nothing. And the reason I tell you that story, Michael, is I think it's indicative of this idea that when we take on shareholders and we no longer control the company we founded, bad things can happen. And Rob Walling decided to say, I'm going to keep 100%, even though it's a small business and will never be a big business, but I'm going to control it, versus Rand, who took the VC money and ultimately lost control and a lot of value along the way. So I'm a big proponent of big piece of a small pie. And because I just think it's a much better way for most entrepreneurs to go.
Yep, good point. So definitely think twice before taking VC money. So going back to the main premise of build to sell, of how you prepare your business to run without you, would you give me like a quick overview of the steps that are universal in that sense, that would apply to all types of businesses?
Yeah, again, there's a lot. I mean, we can't go through the entire book's premise, but the overarching sort of theme, if you will, like the arc of the idea, is to create a business that can thrive without you. And so, for an e-commerce business or a SaaS business, that's really in a lot of ways, it's about documenting the way you want things done into a set of processes and procedures. So, again, most founders know the way they want to see it done, and struggle to get employees to do it the way they would want it to have done. So creating processes, procedures, systems for your company so that it can effectively run without you. I mean, the only thing better than a system that somebody can follow is technology, automation. So obviously, you're going to want to automate as much as possible. But if you can't automate it, at least create a system. I mean, if we go back to Ben Leonard, the guy who built Beast Gear, one of the things he did was had people publish pictures of them achieving their workout goals and push them up to, or publish them on his Instagram page. Well, when they did that, Ben sent a DM, direct message, to the athlete saying, congratulations on hitting your PR using Beast Gear, et cetera. Here's a 10% coupon to buy your next set of skipping ropes or whatever on beastgear.com. That process became quite cumbersome for him to do personally, especially as he grew the business. So he hired some virtual assistants to do that job, to email, to first of all scan Instagram, to then direct message each person, that was him doing it his way manually at the beginning. But then over time, he scaled that by hiring people to do it. But he needed to give them the formula. He needed to give them the system, the script, the process to follow. And I think that's the kind of thing that an e-commerce company or SaaS company needs to do is create effectively entrepreneur-like behaviors being delivered by non-entrepreneurs.
Yeah, absolutely.
Right?
So John, what would it be like for a company that is very dependent on the owner? If the owner has a public profile, like let's say if you wanted to exit the value builder system, how would you prepare it to run without you? Is that possible for, like in general, for companies that have a public profile of the owner? Is it generally possible to exit, you think, the operations?
Yeah, I mean, you want to separate the personal brand from the company's brand. So the value builder system has its own brand. It has its own president, a guy named Sam Mendelson. It's a company with 800 advisors around the world that implement the system. So it's very independent of me, an author of the book Built to Sell. So I think one of the things you need to think about is the branding architecture. So for example, if you have a personal brand or any sort of personal profile, you want to make sure that's distinct and unique from your company brand and profile, right? So for example, if you can avoid putting your name in the company name, that's going to be a good idea. Making sure your brand at the company has a distinct profile and a unique marketing engine. Like acquirers care about recurring, sustainable business, right? And so if the business needs you as the personal brand to generate leads, well, then it's not going to be valuable without you. But if you've got a system, a formula to creating leads, let's say you have great organic search, or you've got a whole outbound sales team that brings in deals for you. It's got a system for generating revenue without you as the founder. And that's the kind of system that an acquirer is going to want to see.
Yeah, absolutely. What about something complex, like other structures that might not fit well? For example, a private equity company. Have you seen private equity companies being automated like that and being able to run without the owner?
No, private equity companies are usually just a collection of individuals. They have no value in and of themselves other than the assets they own. They're not valuable ongoing businesses. Like when we think about the value of a company, you've got the asset value of a business, and then you've got effectively the market value of a business. The asset value is like you basically just roll up some auctioneers and a truck and get rid of your stuff. You sell off your computers, your desks. That's the asset value of a company. And private equity groups are the only value they've got is the assets, the underlying assets they own. For a business, if you've got a SaaS company, for example, that's a bad example, an e-commerce business, and you sell for your assets, it's like literally your inventory and the desks. It's the worst possible outcome. It means that there is no value being ascribed to your ongoing operations. Whereas when you sell at a market value, you've created what's called goodwill, which is the difference between the market value of your company and the assets of your company. Like if we take Salesforce.com, what are they trading at? Like $100 billion right now, I think, is the value of the company. Well, what do you think the value of the desks at Salesforce.com are and the computers? Like maybe 10 million, maybe $100 million. But the difference between the market value of Salesforce.com, $100 billion, and its assets is $99.9 billion. That's because they've got a great business that's created incredible goodwill. No, I don't think any private equity companies are worthless entities. They are just a bunch of partners that are investing some money. It's like, I don't mean that in a pejorative way. They just don't have any value other than the assets that they've invested. There's no value in them other than, again, unless they've invested in great assets, in which case they have tremendous value. You could look at BlackRock or any of the great, incredible private equity groups. In and of themselves, a bunch of guys in a suit on Wall Street, that doesn't have any value. What it has value is the businesses they invest in.
Well, I disagree. The value is in systems that they create. They create systems, at least the good ones, create systems on how to value different businesses. They create their own proprietary deal flow. They have their own due diligence systems. They have great
Well,
people who analyze deals and understand them. They have people who manage those companies and operate those businesses. So it all has
I think
value.
I think that's true if they've done all those things, Michael. You're right. If you've got it, again, I don't mean to be dogmatic, but if you've just got one or two people who are investing in stuff and it's all in their head, then clearly they don't have the private equity group in of itself doesn't have any value. But if they've done the things you're describing, which is really what the Built to Sell process advocates, right, is to create systems and processes that are dependent. So replicatable processes. So for example, how are we going to evaluate deal flow? What do we do to evaluate? What are our investment criteria? Can we do that objectively? Do we have a brand? Do we have a way to generate deal flow on a proprietary basis, as you point out? If we've got that and we've got a system around that, then you're building more value than the underlying assets. Most of the private equity groups that I've seen, especially small, don't have many of those things. They are a few partners in an office trying to get some deals. And that's a totally different model. But I would agree with you that if you've done that, you can create some value. But again, systems only are so valuable in that they still require human beings to execute, right? If you can create things that are automated, then I think you create more value over time that don't require humans to kind of run them.
It's true. What would you say are the biggest challenges for facing business owners who are going towards the build to sell path of structuring their systems and setting up SOPs and everything for each process? What would you say is
I think for a lot of founders, it's the dopamine drip that we become addicted to when we focus on the short-term success. We have a tool called the Rainmaker's Dilemma, which is basically that for a lot of entrepreneurs, they're good at selling. They're good at writing marketing copy. They're good at selling customers. They're good at influencing people. And they spend a lot of their time on those things. And they do that by and large good measure, because if you look at, current books, Now Discover Your Strengths Finder, there's a whole kind of prevailing wisdom that says that entrepreneurs should A, find out what they're good at, B, do that more often. And for most founders, that means selling and marketing. And that's the Rainmaker's Dilemma, because as you reach a point, again, it happens at 500,000 or $1 million or $1.5 million revenue. Whereas if you are the primary sales engine for your company, your business will reach a plateau beyond which it can't grow without you. And so I think, the biggest challenge is stopping to sell your product and starting to sell your company. It goes back to and I was lucky enough to be part of an event called the Birthing of Giants. I know it's a pretentious name, but it's now since been rebranded Entrepreneurial Masters Program. But it's an event that takes place at Endicott House, which is the sort of executive education center at MIT, and just outside Boston. And I was I was invited to go attend this thing. It was a 3-year thing, and we got great speeches from. We had Jack Stack came and talked about employee ownership. We had Pat Lencioni, the guy who wrote The 5 Dysfunctions of a Team, come and talk about leadership. So it was amazing. This one guy came in, I think his name is Watkins, and he's one of the last speakers. I almost didn't go because I was burnt out and tired at that point, but I went. And he starts his speech off by saying, okay, great. How many of you, there were 60 of us in the room, this amphitheater style seating. He said, how many of you raise your hand if you're involved in the selling and marketing of your product and service? And every one of our hands went in the air. And he said, all right, put your hands down. And he said, you've all got the right skills. You're selling the wrong product. You need to hire salespeople to sell your products and services. But you should be taking those skills of influencing, of marketing and selling, and investing them in selling your company. You make millions when you sell your company and thousands when you sell your product. You've got all the right skills. You're selling the wrong product. Again, this goes back this was 22 years ago that I was involved in hearing that speech. But I've always remembered that speech because I think for many of us as entrepreneurs, we focus on the short-term win of winning that new customer, sending that new email, coming up with a new launch plan for XYZ product, which is all great. But if that's how you spend the majority of your time, you're running on a hamster wheel. You've got to take those skills and effectively systematize or build a framework so that other people can do the selling, training people on how to do the work, creating the sales processes and so others can do the work. That's what we call the Rainmaker's Dilemma. And I think it's probably the biggest challenge that entrepreneurs have. It's sort of inside their own head, if you will, that the desire for that validation and that win that comes from making a sale as opposed to building a business that can sell on its own.
Yeah, so the eternal struggle of an entrepreneur, the business owner, prioritizing the urgent over the important.
Yeah. Well said.
So let's talk about different types of businesses. Have you found that some businesses are maybe easier to sell, easier to structure and organize than others? Let's say e-commerce, software businesses, SaaS. And what types of businesses do you see people or services business people work on the most when it comes to using your systems?
Yeah, so at Value Builder, we help entrepreneurs improve the value of their company leading up to an exit. We've worked with 60,000 business owners now across the world. So it's a big system. What we see is that virtually every industry right now is being rolled up. So when I say rolled up, I mean they're private equity companies that are trying to buy businesses in just about every category. And usually they'll pick an industry and create some synergy. So I know of a private equity group, for example, that's rolling up dental practices, one that's rolling up pharmacies, one that's rolling up advertising agencies. I mean, it goes across the spectrum. E-commerce is obviously a perennial winner. There's a ton of e-commerce businesses that are being bought and sold right now, and indeed private equity companies rolling them up. In the case of Ben Leonard, the guy who sold Beast Gear, it was a private equity company doing a roll-up of sports accessory companies. So it's a very common business model right now. And of course, private equity companies are fueled by cheap debt. So as long as debt is basically free, private equity companies will exist, and they are buying and investing in more and more and more companies. I think that's one way to look at the kinds of industries that are rolling up, is where is the private equity money being sort of focused. Clearly, anywhere where you have a service business, it's a challenge. Not only is the pandemic wreaked havoc over all service businesses, but it is also a challenge because they're deeply dependent on the owners typically to run. So you likely have what's called an earnout, where, as you know, Michael, the proceeds of the business sale are paid over time, contingent on hitting certain goals in the future. So service businesses are in that space. But I would say, I think your listeners are in a great spot, because many of them are SaaS companies or e-commerce companies, technology companies. I mean, those are perennial winners, and there's always a marketplace for those companies.
And so for people who go through your system and they organize their business to the point that it can be sold, do you see that many of them regret it and decide to continue running it because now it's suddenly much easier to run? Or do most of them still decide to sell it?
Yeah, it's a great question. I think there is a cohort of people who start and they're just frustrated, right? They're all what we call push factors, where they're frustrated with red tape and bureaucracy and employees, and they go through the process, and at the end they've got a business that can sort of thrive without them, and they're like, hey, this is a great business. Why would I kind of sell it? Again, I don't think that's the majority. I think that's the minority. We try to talk to business owners when they come out the other side, and the sale of their business would be enough to create enough liquid wealth to live for the rest of your life. I think we do try to have the conversation with them and saying, is this, do you really want to risk what you've created for something again that you may not necessarily want. So I think the majority go on to then execute a sale at some point once they've sort of built a business that can thrive without them. But you're right. There are some that I'm trying to think of one off the top of my head, but I can't right now. But there are some that say, you know what, this is great. I'm gonna hold.
How long does this process usually take to get an average business and get it to a point where it can thrive without the owner?
Man, it's like how long is a piece of string? I don't mean to dodge your question, but it depends on the kind of intestinal fortitude of the owner and how willing they are to rip off the Band-Aid. I mean, I'll give you an example. And this goes back again 20 years ago, similar time when I was at that Endicott thing. I used to run a quantitative market research business, and we did custom projects for big banks, phone companies, technology companies. And we had great clients, Bank of America, Google, Apple, they were all clients. But each job was custom. And I got looking at the world, and I looked at Bloomberg, I looked at Forrester, Gartner, all these companies, these research companies that I considered sort of peers. They were moving to syndicated market research, right, in an effort to juice their multiples. So they do one piece of research and sell it to all of their subscribers. And so I thought, wow, this is an amazing business model. And we created at my company a subscription to our research. And we went out to all of our customers, again, banks and technology companies, and we said, look, we've created this subscription. Would you like to buy it? And they were like, pleasantly interested in what we had to offer. And they kind of asked some perfunctory questions, but basically fairly superficially interested. And they would say, great, now that we understand your subscription company offering, let us think about that. But while you're here, we have this project that we'd like you to do. And they'd go on to tell us about some other custom project they wanted us to do. And so we went along talking to all of our customers about this subscription offering. And we could only get roughly like a half a dozen of them to buy. Like it was a failure. We couldn't get it to work because we didn't look serious. We looked half pregnant. Right? We looked like we wanted our cake and eating it too. We were willing to take the custom stuff, but we also want the syndicated, scalable stuff. Anyways, long story short, when we were running these kind of business models together, it was clearly not working. Cash was being sucked out of one side of business going to the other. And so we decided to turn off the subscription offering, go back to just doing custom work, tail between our legs, et cetera. And it always haunted me, the fact that we couldn't get it to work. And so 2 or 3 years later, I decided to take another crack at it. This time I made one fundamental change, and that was we gave our customers an ultimatum. We said, we are no longer doing custom work. We're turning off that side of our business. And so the only way we can continue to have a relationship is if you invest in our subscription. And we went on to describe the benefits of that subscription, why we thought they would be better served by the subscription. And the posture of our customers changed instantly. All of a sudden, they went from being kind of superficially interested, pleasantly listening to all of a sudden leaning into the conversation, saying, okay, if you're going to risk our relationship for this, I need to know more. How many subscribers? How's the research done? How's it priced? What's the guarantee? Like all these like very buying related questions. Anyways, long story, we got most of our old customers, our legacy customers, to move to the subscription model. We then used that as a platform to scale up the subscription model. The company was acquired by a New York Stock Exchange listed company that became Gartner Group today. But it never would have happened had we not given our customers an ultimatum. So I think, I can't even remember your question, Michael, but effectively that's what I would say for people who, really want to dive. I remember what your question was. It was, how long does this all take? I think it's about, are you willing to dive both feet in? It's strong cheese, but if you are, it can be done much faster. If you want to peck away at it over years, then clearly you can make this in a more evolutionary process than a revolutionary process. If you're serious about moving quickly, you may have to rip off the Band-Aid.
So would the average be like a year, 2 years, based on all the companies you worked with?
I don't know the actual number off the top of my head. I think we looked at it. we looked at it about a year ago and did a cohort and looked at how quickly people could move their value builder score. And the average was 19% over a year. The value builder score, to give you a sense, when people start with us, we have them complete the value builder questionnaire. We give them the score out of 100. The average score is 59. Those businesses on average are trading at 3.5 times profit. When you go through and improve your value builder score up to 90, those businesses are trading at 7.1 times pre-tax profit, or more than double the business when they started. That change from going from a 59 to a 90 is the journey. And again, average business improves their value builder score by about 19% across a year. So you can do the math on how many years it would take to go from a 59 to a 90.
So you mentioned subscriptions and kind of automated customers. Is that what the book, The Automated Customer, is about?
It's creating subscription revenue in any industry. That's right. Yeah, what we found was that Built to Sell provided a great framework for people to think about how to build a valuable company. But the real sort of accelerant, call it jet fuel, on the value of your business is going to be recurring revenue. That's where a company goes from trading at a multiple of EBITDA to trading at a multiple of revenue. And so for a lot of business owners, I mean, SaaS companies clearly moved recurring revenue 15 years ago. So it's not for SaaS companies per se, but it is for e-commerce companies and other businesses that are still selling in a transactional business model where they're selling one-off. I mean, I'll give you an example. We talked about Ben Leonard. It was a transactional business that traded around 3 times EBITDA. Again, I don't want to take away anything from Ben. He built a great business and did a lot of great things. But it traded at a relatively low multiple. Again, part of that was the Amazon dependency. But part of that, it was a transactional business model. And transactional businesses do trade at much lower multiples. Compare that with a guy named James Murphy. James Murphy built Viviscal, which is like a hair loss treatment for women. He built it up to $50 million in revenue. But a third of his revenue, get this, a third of his revenue was people women effectively buying Viviscal on subscription. A third of his revenue. Why? Because it's a topical treatment you put on your hair and you need to auto ship that. It's not something you do once and it's not one and done. You've got to use it over a period of months and years. A third of his revenue was coming from subscriptions. When he sold Viviscal, he sold it for 165 million euros. Again, 50 million euro business, sold it for 165 million euros. So not a multiple of EBITDA, but in his case, a multiple of revenue. Same e-commerce business, similar e-commerce business, many of the similar attributes, but in his case, he had a third of his revenue coming from subscription, sold it for 3 times revenue, not 3 times profit. Again, we could argue all day about the differences between Viviscal and Beast Gear, but one of them for me that stands out is recurring revenue.
Yeah, it's a good point. So the customers are kind of dependent on the product in a way. They keep buying, so there is a subscription. And that's also why we see SaaS businesses typically trade for higher multiples in our industry compared to e-commerce and content and other businesses. The recurring revenue is definitely a big change. And so just briefly about your latest book, The Art of Selling Your Business. Can you summarize it just in a minute?
Yeah, sure thing. So I've mentioned a couple of times people like Rob Walling and Ben Leonard. I've interviewed them on my podcast, Built to Sell Radio. So I interview a different entrepreneur every week, done it for 5 years. We have something like 300 episodes. And what I've seen over time is that most entrepreneurs trade at an industry average multiple. So if your industry is rolling up at 4 times EBITDA, most of the people I interview trade in and around the prevailing multiple. There is, however, this group of entrepreneurs, people like Rob Walling, people like James Murphy, the founder of Viviscal, who trade at multiples of revenue, trade at multiples that are so far outside of the industry average that it got me curious. I was trying to figure out, what do they do differently? And so I tried to codify their approach for punching above their weight, or your weight in this book, The Art of Selling Your Business. And the name comes from this notion that for most people, they think of the value of their business as being predetermined. It's just based on my industry. Yet again, there are these entrepreneurs that seem to punch well above their weight. And for them, the process of selling a business is more of an art form than it is a science. There's a marketing and a messaging component to it. And so that's what I've codified into a sort of a recipe to follow in The Art of Selling Your Business.
Right. Well, thank you, John. That was a pleasure to talk to you. How can people reach you online, or how can they find out more information about Build to Sell and the radio?
Yeah, the best thing to do is go to buildtosell.com. And if you click on, there's a button at the top right corner called Free Gifts. If you click on that, you'll get a video series on the 8 key drivers of company value. We've also put the Art of Selling Your Business workbook together, which is sort of a sister book that is designed to be used with the book, The Art of Selling Your Business. You'll get that for free, along with the 9 subscription model checklist. So yeah, it's all available free at buildtosell.com.
Well, thank you, John. Have a good day.
Domain Magnet is a leader in buying and selling online businesses with a proven track record of expertise gained from over 300 deals since 2004. To learn more about how we can help you acquire or exit a profitable online business today, head over to domainmagnet.com for more details.